morning everyone, welcome to the point. In this video we will discuss various aspects pertaining to the monetary policy. So let us see what monetary policy is all about. It is a policy used by the central bank of any country. So in India, what is the central bank? It is RBI. For America, it is Federal Reserve System. And for China, it is People's Bank of China. Okay, so a policy used by the central bank of any country to regulate the money supply in the economy is termed as monetary policy. So what is this monetary policy? This is a tool which a central bank uses to regulate the money supply or the flow of money in the economy. So by manipulating monetary policy, what central bank does is they either inject the liquidity in the market or suck out the liquidity from the market. So for this, central bank uses various tools for the same, which could be further divided into quantitative and the qualitative tool, which we will study in the later part of the video. By this, the central bank decides if the supply of money is to be loosened or tightened in the economy. So by loosen means when the central bank change the monetary policy as to increase the money supply, so it is referred to as it is loosening the monetary policy, and when it takes out the liquidity from the economy, it means the central bank has tightened its monetary policy. Now, why does the central bank needs monetary policy? They need it because of the three main objectives. The very main objective of monetary policy is to control the inflation in the economy along with stabilizing the growth. So now how do they control the inflation? We'll study in the upcoming slides. Right now we'll just stick to the objectives of monetary policy. So the first objective was to control the inflation. The next one is to reduce the unemployment in the economy. And the third one is to maintain the proper or the moderate rate of interest, which does not hamper the growth and at the same time keeps the inflation in check. To manage inflation, there are two types of policy that RBI uses. The first one is the expansionary policy. Okay, as the name suggests, expansionary means expanding, and expanding what? Expanding the money supply in the economy, which is done by lowering the interest rates. Now, what happens when you lower the interest rate on the loans? So the loans become cheaper, and more people start availing the facility of loan. Now, after taking loans, people have more money at their disposal, which they use in purchasing goods and services. Now, by goods and services, it could mean anything ranging from a four-wheeler or to starting a new business. Now, what it does is it spurs the demand in the economy, and usually such a policy is used when the central bank has to spur the demand in the economy, or the inflation rate is low, or there is very less demand in the economy. So what it does is it loosens the money supply. How? By reducing the key interest rates, thereby making the loans cheaper, which in turn would increase the money supply in the economy, and people will start spending more and will avail the loans, and again the cycle follows. Just opposite of this is the contractionary policy. Whenever the central bank feels that the inflation is too much in the economy, or there is too much money in the hands of people, so what it does is it increases the interest rate on loans, which would make the loan expensive. So it would increase the key interest rate, which would make the loans expensive, and hence less people would be attracted to take loans, and the money would not be available in the market as it was before. So this is about the contractionary policy, which the central bank follows whenever it feels that the inflation is too high in the economy. So to control it, it increases the key interest rate, and the liquidity is sucked out of the economy. Going on to the next slide, it is who makes the monetary policy in India. So the monetary policy is formed by the Monetary Policy Committee, which is formed under RBI Act. 1934, and it is a 6-member committee which collectively decides upon the key interest rates. It is mandated to meet 4 times a year, and they float the monetary policy of the country. Before this committee was in place, the sole responsibility was of RBI, which is the central bank of our country. So next, let's talk about tools used in monetary policy. So there are certain tools which is used by the Monetary Policy Committee, and by the help of these tools, RBI either take out the money or inject the money in the economy. So we'll first see what these are. So this is repo rate, this is reverse repo rate, liquidity adjustment facility, and marginal standing facility. Now what these tools are and how they are used, we'll discuss in the upcoming videos. As of now, the names you can just read it out here. So I hope you have got some clarity about what monetary policy is all about, types of monetary policy, the tools used therein, and who frames the monetary policy for India. This is all for the video. Thank you so much.